Hey there, everybody. Thomas Wood with Basecamp Trading. It is Friday, December 9th, and we're going to take a look at one of the setups from the futures trading room. The only one today that we said we had a really slow day, and we said this is the only one that actually looks good on longer time frames for a bigger move down. And that was a short setup based on a 240-minute bear flag and a 30-minute trendline break. Now, you know how I'm always talking about look for confluence across several time frames. Well, this is a really good example of that. So we have two different setups. This is what we call a micro trend, where we have an overall downtrending market. Then we put in a higher pivot low, then we break through the trend line and resume the downtrend. And then at the same time, we had a bear flag set up on our 240-minute price chart, which is right here, where you can see the yellow dot saying get ready, and if it breaks the previous bar's low down at 148 and 25, 30 seconds, it triggers the bear flag. So you had two separate short setups on two different time frames, both suggesting that it runs. Now your first target would be hit here on the short because you're significantly undervalued on the 30-minute price chart. And overall, it would have been a really good trade. It would have been selling from about 148, 25, 30 seconds with a stop at 149 and 6. So about 12, 13 ticks. And right now you'd be out at 148 even, just about. So 12 ticks risk, 25 ticks profit. Not a bad trade. So that's all I have for you for today, but make sure when you're placing trades that you can get several time frames lined up. The more time frames you get that line up in the same direction with the same type of directional bias, the higher the probability of having a trade play out and run your direction far enough to give you an attractive reward risk ratio. All right, that's it for today. Have a great weekend, and until next time, happy trading.